Griffin, Blankenship CPA Group, Director of Tax, Jan Kolb, who's been with us for going on 4 years now. And she's been practicing around this area for many years in different firms. Today, we're going to talk about QBI. And so as CJ, I think he said, try to be cool with that term in terms of knowing what it means. Qualified business income. As far as who gets the deduction, that's what we're here to talk about with all our normal caveats. It's very fact specific. I mean, it's very fact specific, and there's a lot of minefields when it comes to the calculations. What are the deduction limitations? That's one thing that I'm alluding to. A lot of minefields, tripwires to go through. What happens between 315 and 415? I have 4 kids. First thing popped up in my mind was I get the report, and no news is good news. And so, but the bad report at 315 and 415, find out what all they did wrong at school that day. So, basic formulas and examples, and then Q&A. So, Jan, I'll hand it off to you, and then I'll jump back in.
Okay. I'm Jan Kolb, so thank y'all for being here. Somebody asked me before I came in here what breakout I was speaking at, and I said the pass out section. And I'm not a public speaker, I'm a tax person, so if I pass out, you'll know why. Carter, could you change it? So first of all, we need to determine what is QBI, or Qualified Business Income. And the new code section 199A defines QBI as the net amount of income, gain, deduction, or loss from a trade or business effectively connected to the USA. The trade or business is governed by Code Section 162, and effectively connected to the USA is governed by 864. So that's an easy enough definition, but trade or business is not easily defined. The difference between an active trade or business and a passive investment. So the IRS looks at Code Section 162 and usually looks at 2 factors. First of all, is the owner working in the business with regularity and continuity? So if you're an owner in a passive company and you're not there on a day-to-day basis, this would not be QBI to you. Secondly, you have to have a profit motive. So this would exclude most of your hobby losses. You've got to at least run your business in a way where it appears that you're making a profit or trying to make a profit. 864 is the effectively connected to the USA. And there will be regulations coming out on this, but some interesting results can happen. For instance, if you import an item made in Mexico and sell it in the USA, right now that is qualified business income. Conversely, if you make a product in the USA and export it out of the country, that would not be qualified business income. I had a couple of questions before I came in. Basically, is QBI net of all your deductions? And it is net of all your deductions, and that includes 179 and bonus. So there's a lot of cases where QBI is going to be what's passed through to you on your Schedule K-1. Secondly, QBI is applied at the entity, is not applied at the entity level, it's applied in the aggregate. So if you run your business through 2 different entities, let's say you make $100,000 in one entity, a $50,000 loss in another, your QBI is at $50,000. Now let's talk about what QBI doesn't include. QBI does not include short-term capital gain or loss, long-term capital gain or loss, dividend income, investment income, or interest income. Special provisions exist for REIT and co-op dividends and PTPs, but generally 20% of that income is added to your QBI. The next item is kind of a big deal. QBI does not include reasonable compensation for services rendered, which would be wages for your S corporations, or 707 payments, which would be guaranteed payments for your partnerships. And it's tempting to reduce your salary or guaranteed payments as low as you can to increase your QBI. But the IRS says you've got to deduct a reasonable compensation from QBI whether you pay it or not. Now, there are some planning things that can happen here. If you're an S corporation and you've traditionally always taken your wages out, all your profit out through wages, it will make sense to reduce your wages to what reasonable compensation could be construed as and take the rest as dividends. This is especially attractive now that the whole income tax is being phased out. And guaranteed payments, same thing. Reduce your guaranteed payments to as low as you can justify and take the rest through an equity distribution. Just realize there's a lot of planning that can go on here, and we're happy to help you with that. QBI can be limited based on the type of trade or business. And I think Marilyn already talked about that a little bit, service type businesses, and Chris will get into that in more detail. And performing services as an employee is specifically excluded from QBI. So that means you can't pay your employee a 1099 and try to generate QBI for him. If they meet the definition of an employee for the IRS, they are not allowed the QBI. So let's talk about who is eligible for the QBI, and they've been very generous in this. So all sole proprietorships are eligible. Again, there are the restrictions. Single member LLCs, so those of you that report on the Schedule C, S corporations, partnerships, including publicly traded partnerships, multi-member LLCs, and there's no limit on how many members you can have. Schedule E real estate investors, and we started this because rental income by definition is passive income. So you've got to be able to prove that you're in the business of rental and real estate activity. Trust and estates with an interest in a pass-through entity, qualified cooperatives, and real estate investment trust. So the purpose of the QBI, as Marilyn talked about earlier, is to create a potential 20% deduction in order to achieve an effective tax rate more comparable to the new corporate tax rate of 21%. So QBI, is important to note, is a deduction. It's not a credit, and the 20% is not a tax rate. So the deduction is going to reduce your taxable income, which is then taxed at your new ordinary income rate. It is also not a deduction for your self-employment tax. So if you're a Schedule C or a partnership, you're still going to pay self-employment tax on the gross amount of income. It's also not an itemized deduction. So if you're going to be able to use the new higher standard deduction, you will still get the QBI in addition to that. And so it's all-inclusive but discriminatory. So they've been very generous, like I said. Everyone has the potential for the maximum 20% deduction, but not everyone will be eligible due to a variety of limitations. And Chris, I'll let you take it away with that.
So the discriminatory, all-inclusive but discriminatory. Again, I alluded to 4 kids. You get the promise, hey, you can take an education credit to send your kids to college. And then you're told you make too much money to get the education credit. So discriminatory. So I would put this in that same group. It's hey, you get it. It's all inclusive until you hit certain thresholds and certain points of income, and then they start clawing it back. I call it political clawback. Basically, a promise and then a clawback in terms of discriminatory. So. When I first heard this, I heard accountants couldn't get this, and this is basically what I was hearing. Performance in service of fields, accounting, actuarial science, athletics, brokerage services, consulting, financial services, health, law, or the performing arts. Basically, if you make too much money, this gets phased out rapidly. I don't know what happened with the architects and engineers. They had a great lobby, but they were pulled out of this, even though they are under the 1202 definition of services. There's also investment folks, financial services, and then as I heard CJ allude a while ago, if you've got goodwill, what we call in the valuation world, personal goodwill versus enterprise goodwill. So are people coming to me for the services, or are they coming to the company for the services? So in this case, it would be a personal goodwill. If somebody's coming to you, there's an argument that could be made by the IRS that you are in this 1202 limited, and we'll get into some of the limitations, this 1202 limited service QBI category. Certain wage and or property limitations that exist. I heard Dr. Young alluded to it. It's basically if you create a profit, and once again, it's a promise, you get 20% of that profit as a deduction. If you do not have certain levels of wages, and we'll get into some examples, it will not be able to be taken back away from you. If you have a rental company where you're not going to have wages, it's just going to be leasing property, and again, not a lot of wage expense required to run the company, there could be some limitations if your property values are not, or the cost values are not as high. QBI deduction can be limited by the amount of ordinary income inside taxable income. Here again, you've got, let's say, $1 million of QBI, 20%, $200,000 would be your expectation to get the deduction. If you've got some other things going on in retirement contributions, itemized deductions, the things that we want to see you have going on in return to shelter your income, that can mitigate how much of the $200,000 that you'll end up getting. Certain levels are limited, 157.5 and 315 for married filing joint of taxable income. Basically, once you start going over those income amounts, married filing joint being 315, 157.5 for all others, they'll start being clawbacks, limitations on what you can deduct. So non-service QBI, what I just alluded to, there's the wage limitation. As I said earlier at the opening, what's between 315 and 415? If you start going over $315,000, there's a phase-in of the limitation where I just alluded to. If you have a $200,000 potential deduction, but you don't have property values or wages to get that, this will start to phase in those rules. Once you go over 415, they're all phased in as far as the wage and property. Service QBI, same concept, except more harsh. It's a percentage of the amount that you go over 315. It starts pulling back very rapidly what you can deduct as the QBI deduction. And then once you go over 415 in the service, not the non-service. The non-service, you go over 415 and still get it depending on wages and property values or cost values. But in service QBI, once you go over that 415 on a married filing joint return, there's nothing there. It's totally pulled back.
So can I just say, so for your service QBIs, if you're operating as a sole proprietor, using your SEP or maxing out your pension plan can be especially valuable this year because you can put up to $55,000 to $59,000 in it, and that could get you below the level, so where you could also take advantage of the 20% deduction.
So 20% of QBI, the basic formula is as I said, $1 million of qualified business income, 20%, $200,000. But you take the lesser of, then we look to wages. Let's say we're over 415, so we don't get into the whole phase in because that's a lot of percentages in terms of it's a pro rata piece. So let's just say we're over 415, and the full amount is going to be limited based on your wages. So if you've got $1 million of qualified business income, $200,000 potential deduction, your wages need to be $400,000. You can see that $400,000 times 50% is $200,000 because it's going to take the lesser of. We'll have an example here in just a minute that'll drive the point home. If you've got a property company, as I alluded to, then it looks to 2.5% of the unadjusted basis of the qualified property and 25% of the W-2. So you've got calculations going on in this box, comparing it back to this box, my $200,000 example, take the lesser of. Also, my $1 million example, if you have a $1 million loss in your qualified business income, you've leveraged, you've been growing, writing things off, and you've got profits coming forward, that $1 million will carry over to next year. It'll carry over to next year, so if you make $1 million next year, then you net to zero in my example. So, and then subject to the aforementioned limitations, 315, 415 is critical. Here's examples. So service QBI. We've got QBI net profit, and let's say it's an accountant, and there's $200,000 in scenario A. We've got wages that were paid to create that $200,000 profit. We have on the 1040 of the accountant, we have a spouse making $50,000. We have capital gains income of $50,000 and itemized deductions of a negative $50,000, leaving taxable income before the QBI of $250,000. Well, in that case, we weren't limited. We take $200,000 top line times 20%, it's $40,000. We're good. We get the whole deduction in that case. Column B is the phase-in. That's between 315 and 415. If you'll notice, $350,000 on this line right here of taxable income before the QBI deduction. That's between 315 and 415. So it starts to strip away part of the $40,000 to clawback. So it would be $60,000, $300,000 top line QBI net profit in column B times 20%, $60,000, but it strips away, and it only you only get a net $34,450. And so when you get to $700,000 in that example, that's where I was saying that once you go over 415, 750 in this case, but once you're over 415, it's totally gone. So $700,000 should have generated $140,000 QBI deduction that's not there. The non-service QBI, as I was talking about, not as harsh, but still limitations. So same example, 200, 300, and 700, and then just drop down to the QBI deduction, $40,000, just like over here in the service QBI example. Then we've got a higher amount that's allowed as a deduction, and that's because of some of the service QBI rules that don't involve the non-service QBI. So you've got a $53,000 because, again, we went over 315, we're between 315 and 415. We're going to phase in those rules. So $53,000 is our deduction there after the phase in of the rules. It should have been $60,000. We lost $7,000 to have a $53,000 deduction. When we did these examples, we started to change the numbers because what it might look like is the $40,000 in the column C, $700,000 net profit example is the same 40. It's not. The $40,000 in column A is 20% of $200,000. The $40,000 in column C is limited to 50% of the $80,000. If you remember, it was the lesser of the wages times 50%. So you take $80,000, second row, times 50%. That's $40,000. You don't get the $140,000. So it took away $100,000 and gave you a $40,000 deduction instead to get the 710. So hopefully those are some examples to kind of get your head and just think about these concepts and what happens as your income rises. Generally, two worlds: service, non-service. Service being more harsh, unless you're an architect or engineer. Non-service, not so much. Service QBI, the benefits are limited and phase out. What's that? Services, the benefits are limited and phase out rather quickly, as we saw in the example. Non-service QBI, once you get over $550,000, and this is just Blankenship's perspective, you've got a 37% tax rate that you're in. You've run out of the graduated rates. Then you start looking at 29.6. If you can get 100%, not be limited to your QBI deduction, you get $1 million, you get the full $200,000 in that example. That's when it really starts to pay off. Then you're talking about an effective tax rate of 29.5%, 29.6 to be exact. Our final bullet point is that's where we've looked at this and we're not seeing a lot of advantages. There might be a few limited circumstances where you're trying to build capital in your C corporation and you want to leave the money in, don't take it out. There could be some examples where you might want to be a C corporation, but what we find in our companies, you need the money out. You need it out personally. So that'll be double tax once it comes out of the C corporation. So what we're thinking, again, this is a 1 month anniversary of this tax bill, and we've got a lot of anti-abuse rules that are coming and a lot of ideas that will be kicked around. But what we're finding is that it's just better to be a pastor, and it's because of this deduction right here. So, questions? I don't know where we're at on time.
You might go back to the chart slide.
Which slide?
That one.
Yeah.
Good.
Well, I was just going to ask, just to be perfectly clear on the service QBI section, forget architect's vision here, third class.
Yeah, that's right.
So if you're under 315, you get to enjoy the benefit of this. It's only when you're over 315 you get penalized for not being able to.
As the first limitation to look at, that's correct. But there's there's taxable income limitations and things like that you really need to make sure you're aware of in terms of your tax return. That's why it's so specific. I mean, there's so many minefields and potholes along the way. You've got to be real careful. But yes, if you can keep it under 315, and Jan alluded to that, some different ways to maybe try to do some planning and keep it below 315, you're a lot more safe. Yes, sir.
QBI is always applied at individual level.
Yes.
So it's not, so if you got partners in a partnership, and they've got different levels of income, they'll have a different result for QBI.
That's right. That's right. And some of the things, this law being 1 month old today, and there's going to be so many anti-abuse statute things written, splitting it up with kids, splitting your QBI up with kids and just going with a 157.5 instead of the 315 threshold, and trying to get that on a child's return or a trust return. There's all these ideas that are being kicked around, like what way can we exploit the 20% for 8 years now, I guess is what we've got it going on. So, but yes, it is at either the trust or the individual's level.
It should pass through separately on your Schedule K-1, just kind of like your income does. There should be a separate line item for it.
Questions?
The wages, does that include the average wages or the taking wages out of all the business?
It does from purposes of calculating that limitation. But as Jan was saying, you don't get to count that as QBI. So if I'm an S corporation owner and I take $100,000 out, $50,000 will go towards this limitation, but I don't get to count $100 towards my QBI for a $20,000 potential reduction.
It's a small detail in the corporate session, we wanted to entertain is, is that apply for pastors?
It does, yeah. That's right. Other questions? Thank you very much for coming this morning. Appreciate it.
Blankenship CPA Group is a top 10 Nashville public accounting firm that serves our clients' tax, audit, accounting, and consulting needs in the Nashville, Tennessee, and Middle South market through our experienced accountants in our Brentwood, Dixon, Goodlettsville, and Mount Juliet offices. At Blankenship CPA Group, we are not just another CPA firm. Our culture is built on the values of biblical servant leadership, service over self, and exceptional engagement and execution. We believe in building a team of spectacular professional people that share this conviction. This mindset extends not only to our clients, but to our families and our community. Working with Blankenship feels different because our people and our firm is different.